So a lot of you have probably seen this chart from an insurance company which boasts about how their index annuity in 15 years turned $100,000 into $198,725. Now, first of all, without reading the prospectus, I don't even know if this $198,000 is actually cash surrender value or not. And if you've watched this video of mine, then you know how oftentimes these figures are merely a basis for determining income payment rate. And the cash surrender value or death benefit value can be a lot less, and it can even eventually go down to zero if you sign up for one of these guaranteed income riders. So that's critical. But let's just assume that this $198,000 is your actual cash surrender value. And if so, then after 15 years, your annualized return on investment was 4.7%. Now, considering the terrible stock market performance we saw during the 2000s, does 4.7% sound like a good deal to you? It probably does. But if you think 4.7% was a good deal, think again. Index annuities were designed to compete with CDs. CDs are not risky. Stocks are risky. So if all we need to do is earn low-risk type returns, if all we need to do is do better than a measly 4.7%, you don't put 100% of your money in an S&P 500 index fund. That's what a 20-year-old would do, not a conservative investor like a retired senior citizen who would consider an index annuity. They would instead diversify into bonds. So this insurance company chart is completely deceptive. They're putting on a show for investors who are ignorant of how bonds smooth out stock volatility. They conveniently compared their annuity to 100% stocks, no bonds, and did so during a terrible stock bear market. So what would happen if we did a realistic, more apples-to-apples index annuity comparison to a portfolio of a couple of stock and bond index funds? And what is a realistic stock-bond allocation ratio for comparison purposes? Well, in late 2014, Jim Cramer talked about bond-stock allocation ratio on his MSNBC show Mad Money, and he said that generally speaking, after retirement, only about 1/3 of your money should be in stocks, not 100%. So, at the end of 1998, if a conservative senior citizen investor sensibly put 33% of their money in stocks and 67% in bonds, after 15 years, their $100,000 became $226,000 for an averaged annualized return on investment of 5.6%. And this is what the insurance companies know. When they sell these index annuity products, they're making a bet that after they pay you, they will still be able to pay their overhead, still make a profit, and still pay your advisor his lavish commission. So the conservative 3367 portfolio predictably beat the index annuity, and there's no surrender penalties when you sell ETFs. They're 100% liquid. And that $98,725 annuity gain, if you were to surrender all of that money in 1 year or even split it up into 2 or 3 years, do you know how much you would be paying in taxes? Because annuities are taxed at a much higher rate than normal investments like bond and stock index funds. With an annuity, you would be paying $10,433 more than if you sold off that same amount of money from a portfolio of stock and bond ETFs. And even if you staggered those withdrawals over 2 years, with an annuity, you would be paying nearly $11,000 more. And even if you staggered those withdrawals over 3 years, with an annuity, you would be paying about $9,000 more. Did Mr. Commission-Based Advisor tell you about this? Of course not. Folks, I'm not some advisor trying to sell you something. I'm a whistleblower. Index annuities are crap financial products. They're pushed on unsophisticated investors by licensed insurance agents, brokers, and advisors who are also licensed insurance agents. These people are non-fiduciaries, meaning they don't legally work for you. They are nothing more than salesmen selling products that earn themselves the highest commissions. They put their own best interests ahead of yours. So never, ever go to a commission-based advisor for money advice, period. Investing is easy. Lots of people do it themselves. But if you need help, hire a fee-only fiduciary advisor for a one-time consultation.